Welcome. I'm Christina Harms. I am a certified reverse mortgage professional. There's only about 200 of us in the country. Highest designation. If you're getting information about reverse mortgages, subscribe to my channel, but you only want to work with a certified reverse mortgage professional. They know what they're doing. All right, let's jump to it. You're probably looking around for more information, so I want to give you that straight. There's pros, there's cons. Let's figure this thing out together. What is a reverse mortgage? That's why you're here. Do you know what it is? Most people think they do, but they don't actually. Even the experts, even loan officers. I coach loan officers. They come to me with crazy questions. All right, so we're going to go over a few things. Advantages of using a reverse mortgage. Who is a reverse mortgage for? How is a reverse drastically changing someone's life? Karen is our example here. Now, disclaimer, the information presented is for educational purposes only and does not represent a full financial assessment of your circumstances. It is provided for illustrative purposes only, and in the event that you would like to determine any specific relative to your financial circumstances, I recommend you seek help from a licensed certified reverse mortgage professional in your state. I can help in some states. Look at the info below if I might be in your state. I have a link to register if this all makes sense and you want to look at your specifics. Qualifying criteria must be at least age 60, 55, maybe 62. Depends on the product that you're looking at. Now, in general, you're going to hear 62 and above, but I'm in California and quite a few other states have reverse mortgages available for people 55 and up. Bet you didn't know that one. Have around 50% equity in your home. Again, this and why we say around, it's not like other mortgage programs. Other mortgage programs are, we call it loan to value. They're very straightforward. It's like 80% loan to value. You have to put 20% down. It's not how it works in reverse. It works by current interest rates, the youngest borrower's age, the property's value, and the program that you're on. That all comes together into a system we all use, to figure out what your loan amount is going to be. So there's no generalities. And my biggest advice here is don't try to figure out the math yourself. I don't even do it myself because these are constantly changing. The slightest interest rate change, if you're 6 months closer to your next birthday, all these things, and if your property value is overinflated or it's not quite as high as it is, it's going to make a difference. So you want to have a conversation with an actual professional, and hopefully that professional is professional and understands what they're doing. CRMP. So you want about 50% or less. Now, the common way we do reverse mortgages is to actually pay off an existing mortgage. The misconception is that you have to have a free and clear home, no mortgage at all. That's actually like 20% of the people I help. About 80% of them were actually getting rid of an existing mortgage, so they have no more mortgage payments. Again, live in the home as your primary residence. Single family homes may qualify. Not all do. There's some, again, it's a mortgage, right? So there's some specifics here. Some condos may qualify, some manufactured homes may qualify, and some 1 to 4 units. That's one of my favorite structures, right? Put a reverse mortgage on the property that has 2 or 3 units or 4 units. Make the mortgage payment go away, but rent out the other unit so you have retirement income flowing. Great structure. FICO score kind of matters. We can actually get through most files without a FICO score. There's ways around it. So if you don't have a FICO score or if you have a really low FICO score, don't disqualify yourself. Just know that you may have a little bit of a tougher time to get the loan, but it's possible to get it. Have an income source and credit score. I've actually done loans for people who don't have an income source, but in general, again, that's the exception, not the rule. Most people are going to need to have, Social Security. If you have a significant amount of your equity, that can actually help you qualify too. Primary residence considerations. So what does this thing mean? You have to live in the home for 6 months plus 1 day of every year. If you move out of your home because of divorce or separation, that may be a problem. Now, if one borrower remains, that's fine. You meet someone and you want to live with that person. Well, That's something that we actually see. I was talking to somebody earlier who got married after they did the reverse, and the spouse was not part of the loan. So we're refinancing to get that spouse as part of the loan so that if and when one of them passes, nothing changes for the other one. So if there are two borrowers, one borrower is protected. It's a better structure. If you are in that situation, or if you do get married later, look into refinancing that spouse onto the loan too. It'll be more protective for them. Turn your property into an investment property, right? That 2 or 3 unit situation I was talking about. That's a great structure. Now, if you're considering moving out of your home permanently and renting out your primary residence, reverse is not going to be a good fit. The mortgage is due if you move out permanently. Or if you want to sell the home. When is a reverse mortgage not a good fit? I get asked that all the time. Well, if you're just going to remodel and fix up the place and you're looking for some cash to do that so that you can sell within 1 or 2 years, a reverse mortgage is not a good fit. Why? Because there's some upfront costs to do this thing that really makes sense the longer you keep the loan. Now, 5 years still makes sense. We look at structures all day. 1 year, 2 year, now go get a HELOC or figure out another way to get cash. Who is this for? People looking to help their kids buy a house or send their grandkids to college. I've done a lot of those. It's awesome. Why wait till you pass to be able to help your heirs? Some of them are really in need of help now. People with large medical bills or with health issues, structuring a large line of credit for what may happen in the future so you can just get that money when you need it really, really takes a lot of worries away. People who don't want to go to a care facility and want help brought into their home. This is a very common structure. Mom or dad is in their 90s and they finally need care, but they don't want to go somewhere. They want care brought into the home. And the home has a lot of equity. So where can we get the money to pay for the cost of care? A reverse mortgage fits with that situation really well. People who want to buy a second home. This is a great one. Instead of pulling from your assets that are earning interest, do a reverse mortgage, pull some cash, and then you can buy that second home. And you're not incurring a new payment to do so. People who are financially savvy and can take the money out and invest it elsewhere well. Not everyone can do this. I don't advise this to everyone. But if you have a proven track record of being able to invest well, this can make a huge difference in your retirement. You need to be able to invest at a higher rate than what the interest is being charged on the loan. So again, not a fit for everyone, but I will say I've had just one client who did it. I don't advise this strategy, but I had one client who he got about $400,000 out of his reverse mortgage, invested it really well, and turned that into over $1 million. That guy's pretty excited he did a reverse mortgage. People who are divorcing or separating. Now, I want to put a caveat on this. If you know the numbers can work to cash out the leaving spouse, then a reverse mortgage is a great fit. But if you haven't run those numbers, if you're not at the end of your divorce figuring out what the money situation is going to be, who's going to have to pay out what, then don't do a reverse until you know those numbers. Now, I've done many reverse mortgages so that one spouse can stay in the home and cash out the other one of the portion that they're due, and they can go elsewhere. So that can be a really, really nice thing. I work with divorce attorneys. We call it gray divorce. We even have a name for it because it's common. Now, there's no term. The way the reverse mortgage works, too fast. There's no term. So what do I mean by that? Well, typically people think, 30 years, that's how long a mortgage is. Typically, yeah. But a reverse mortgage, the way the note reads, is that the lender or the bank has the right to reassess the mortgage note 50 years past the borrower's 100th birthday. So that means you would have to be 150 years old for them to reassess this thing. Nobody's lived that long yet. Maybe you will be the first to get there. I hope so. You'd be in a fantastic financial situation. You'll have really taken that bank to the cleaners if that's the case. But what that means to you is that if you're like 62 right now and looking at maybe I should do a reverse, and you have longevity in your family, maybe your parent lived to be 99, 103, 106, something like that, then a reverse can be a really nice protective way to make sure that your housing cost, no mortgage payment, but you're not leaving all your assets tied up in that way. It's a really cool thing there. It's very unlike any other mortgage. And we're going to get to it, but that's why there is mortgage insurance on this thing. Think about it. There is going to be somebody who lives to be 130, 140 with a reverse mortgage on their home someday. The insurance picks up that difference. I can go over that in person a little more. I'm not sure if this presentation, that's higher level. So when the home is sold, when is the reverse mortgage due? When the home is sold. Now, this is an important thing. You are the owner of your home on title. A reverse mortgage is just like any other mortgage in that it's a lien on title. You are the title holder. This is just a lien on title. So the mortgage is due, instead of being in like 30 years like other mortgages are, it's due at events. We call them maturity events. When does the loan mature? When the last borrower passes away. It says person here, but it's really the last borrower or non-borrowing spouse. If you happen to have a spouse who is under the qualifying age, talk to someone. You can likely still do your mortgage. When the home is sold, you can sell at any time. There's no prepayment penalties. You are still the owner. When you move out permanently, and that's both borrowers, if you were to happen to stop paying your property taxes, your homeowner's insurance, or any HOA dues, or any other property charges, sometimes we'll see things like flood insurance required. Any property charges, you have to keep paying. You are the homeowner. Now, we have to emphasize this with reverse, and this is where the big gurus talk about, oh, reverse is terrible, because it's more common that people forget to pay these because there's no mortgage payment. So, and we're dealing with an elderly population, right? If you get the reverse mortgage when you're 68 and suddenly when you're 98, your mind is starting to go, well, no matter what the financing on that home is, you're probably going to need somebody to come in and help make sure you pay your property taxes and homeowner's insurance and your other bills. It's not just unique to the reverse mortgage, but because there's no mortgage payment required, they're not taking it out of the mortgage payment that you're sending in. So we really have to emphasize, you're not selling the home to the bank. They don't own it. You own it. And with that, you have to pay your taxes, your insurance, your HOA, maintain the home. If you don't maintain the home to FHA standards, that's also a foreclosure event. And now I say foreclosure, most people go, oh, foreclosure is terrible. Well, foreclosure is the natural word for what a mortgage lender has to do in order to close out a loan if they're not getting cooperation. So it's just the natural course here. It's not common that they actually do that. Most people will sell. Most heirs will pay the mortgage back in one way or another. But that is a phrase that we hear more often. A reverse mortgage is one way to guarantee you have a roof over your head with no mortgage bill due, possibly for the rest of your life, right? If you live in your home for the rest of your life, that's great. Not everyone will. Some people will have to go to a higher level of care. In that case, mostly the families are looking to sell the home to get the rest of the equity to pay for that care. And yes, the big misconception is that, oh, my equity's all gone. They change the program so they don't lend as much. And when you run your numbers, you'll probably be disappointed thinking you could get more money out of your home. You can't. Their numbers are much smaller than they used to be. And that's why reverse mortgages got a bad rap back in the day, because they would lend a huge amount of the equity and then it wouldn't take that long until there wasn't equity left. That's not the case these days, especially when we have appreciation going nuts like we do. When the appreciation increases, your equity increases. So why a reverse mortgage? It's flexible to meet whatever your retirement needs are. A reverse mortgage puts you in control of your payments. You can still make a payment if you want to, but you don't have to. Why a reverse mortgage? Pay off your existing mortgage, the kind that has required monthly payments. Set up a line of credit. Now that line of credit grows, so you have increased access to your equity over time, assuming you don't draw it down to zero. Again, talk to a mortgage professional, a reverse mortgage professional about this, but a line of credit is a really beautiful, beautiful aspect of the reverse mortgage. It helps protect your future too. You can receive monthly payments. Now, these are not as common today as they were like 10 years ago, 20 years ago. You'd see those cheesy TV commercials, and that's like the late night TV commercials, which are get money from your home every month. Now, is that a possibility? Absolutely. But in my practice, that's not the most common structure I do. The most common structure I do is make the existing mortgage payment go away by paying off the existing mortgage and setting up a line of credit for what may happen in the future. The equal monthly payments for as long as you live in your home, I love that structure because it protects you if, say you are that person that lives to be 120. Equal monthly payments for as long as you live in the home. If you were to need that money from the line of credit, you might draw that line of credit down to zero and then it's gone. But those equal monthly payments would continue on. It's a great structure. Obtain cash. This is a really common one. So many things happen in retirement. You're not alone. I can't tell you how many times people call and say the unexpected happened. Well, of course it did. You should expect the unexpected because you're in retirement now. There are bigger chances of falls. There are much bigger chances of having big medical diagnoses. Your adult children in the rising cost environment may need help. College for grandkids, family events, new cars, new roofs, dental expenses. I can't believe how many reverse mortgages I've done to help people put in new teeth or handle their dental bills, medical bills, credit card debt. Credit card debt is typically between 19 to 26%. Now, the rates on reverse mortgages are all typically well below 10%. Of course, depends on what time, this video is going to live on. So right now, reverse mortgage rates are in the 6s and 7s. Depending on what time you watch this video, there's been times where they're in the 2s and 3s, and there's been times when they're in the 8s and the 9s, but that's much better than 18 or 19 to 29% on credit debt. 70% of seniors carry credit debt in retirement. And that's just a hamster wheel. All right. Why reverse mortgage still continued? Reverse mortgages are really powerful for people who don't have large mortgages or no mortgage at all. Unfortunately, I tell a lot of people, I'm sorry, I can't do this for you because they simply don't have enough equity. So if you are in the position that you do have enough equity, pat yourself on the back. There's a lot of people in retirement who don't. Now, the common rule of thumb is, you should have your mortgage paid off. I see people's mortgages situations. The majority don't. So that's just the reality. Yes, the ideal, have no mortgage payment in retirement. And for the people who don't, thank yourselves because now you have access to that. Well, you can give yourself access to that money through a reverse mortgage. All right, let's go over a case study. So a 63-year-old widow, Karen, she didn't have a lot of monthly income. Pretty common. She had $200,000 of assets plus her home. Her financial planner referred her to me and was aware that her money was not going to last. She was only 63, right? $200,000 is not going to last all that long. And she suggested incorporating a reverse mortgage. The house was free and clear, so she had a whole lot of equity to work with. And she asked, well, aren't reverse mortgages bad? Why would I do this? I showed her how she could set up this growing line of credit so she had increased access to her equity over time. And it would grow and grow and grow until she needed the money. That's a beautiful thing. And then when she needed it, it's there. She already put the thing in place. The hardest situations I find, and it's heartbreaking, people wait till they need the reverse mortgage and they wait too long. So they've also typically, now their credit's not great. Now they don't have income to qualify. And the only answer left when they can't qualify for a reverse mortgage typically is they have to sell. You don't want to be in that position. Put the reverse mortgage in place before you retire, please, everybody, while you still have working income. There's still income requirements. There's still credit requirements. So people who call me and they're thinking about retiring, I say, put this in place before you actually do retire. It'll make your life a whole lot easier. And hey, if you never use it, that line of credit turns back into equity in your home. It's just giving you access to it. The line of credit increases over time for two reasons. Your home is expected to appreciate. They don't want you to have to refinance every time your home appreciates in order to get access to more funds. This reverse mortgage is supposed to fit retirement. It was designed around retirees, right? And they don't want people to have to refinance as they get a little bit older. Somebody who's 93 can qualify for a larger reverse mortgage than somebody who's 83, who can qualify for a little bit more than somebody who's 73, who can qualify for more than somebody who's 63. Now, it's not that big of a difference each year. It's not worth waiting. Interest rates make a much, much bigger impact. If you're watching this video at a time where interest rates are low, that makes way bigger impact than waiting until you're a little bit older to do the reverse mortgage. Now, it is FHA insured. The FHA is under HUD. This is a government insured reverse mortgage. We call it the home equity conversion mortgage. And there are other types of reverse mortgages that are not through FHA. The line of credit increases over time. Now, everybody's projections are going to look a little different. So again, I highly recommend you get your numbers, but this is the general trend we see. So imagine if you today, and let's say you're age 68, at age 68, you put a line of credit in place for $100,000 and it grows. Right now, as I said, interest rates are around 6 or 7, so it's growing at around 6 or 7%. It's growing, it's growing, it's growing, it's growing, it's growing. And in 10 years, say you never needed the money, you just sat there and watched it grow happily with a smile on your face. In 10 years, now that line of credit has grown to 140. That's awesome. It's a great structure. It's really protective. Now, in that time frame, say the water heater goes out and you don't want to call your financial planner because you're making good interest on their portfolio, what they're managing for you. Pull it from the line of credit. Just, a water heater, what is that, like less than 10,000? So then the rest will grow. So that's important to note too. If you draw the line of credit down to 0, it won't come back unless you make a payment. Whatever is there, whatever's available will grow. So there we go. It grew to 148 in just 10 years. This is just an example, and it depends on current interest rates. It depends on your age. It depends on your home's value and the equity. Oh, let me go address that. One of the really cool things, if this was with you and you had a reverse mortgage and 10 years in, you had this line of credit that is now $148,000, you could call the company, the number on your statement, and say, I have this large line of credit, but I'm actually finding, you can say anything you want, I'm actually finding that I want monthly payments instead. Can I do that? And they'll type into their computer and calculate the numbers and say, yes, you can do that. We can actually get you this much a month. Do you want to do that? And for a $20 fee, you could have it flipped. So now, instead of having a line of credit, you can turn your line of credit into equal monthly payments for as long as you live in the home. It is just a really flexible thing. It will be flexible through your retirement for you. So typically when you're in your 60s, your income is fixed. This is a new thing for people, right? All through our working years, our income is going up, and then suddenly it comes to a screeching halt, and you don't know how long that money has to last you for. In 10 to 15 years, this fixed income won't go as far as it used to. We're seeing that in a big way today. This mainly occurs due to the increase of cost of living. We just had huge inflation. And medical bills. People underestimate, and I don't know if it's like the invincible thing where, that won't happen to me. That won't happen to me. 1 in 4 people have a fall that affects them in a huge way in retirement. 1 in 4 people. So if you're not currently exercising a whole lot, well, exercising period, but exercise, that will help prevent falls. Falls are really expensive, and a lot of the time, they're one of the last life events. Two of my grandparents were taken down by falls within 6 months and a year and a half. Both were gone after bad falls. So just keep yourself in good shape, please. A reverse mortgage helps you balance today's cash flow with tomorrow's home equity. The balance happens because of appreciation. Your home is not worth what it was 5 years ago. It's worth more. And it follows that in another 5 years, it will likely be worth even more. So even with putting a reverse mortgage on your home, even with never sending in a single payment, which you can send in payments if you want to, in any amount, at any time, or don't. Nobody calls, nobody cares, but they will cash the checks. And it will dollar for dollar increase your line of credit. I'm getting into the weeds here. You need to talk to a professional if this is all sparking your interest. But even though the loan balance is going up, the home's value is also going up. So in the past, a reverse mortgage got a bad rap because here's the home's value, and it didn't appreciate like the appreciation we're seeing today. It was kind of like, okay, barely move it. So home's value, right? Then 15 years ago, you got a reverse mortgage, then they let you borrow a huge amount of that value. And the home's not appreciating that quickly, but the mortgage balance is going up. So that's where reverse mortgages got a bad rap, because the mortgage would sometimes get higher than the value of the home. Today, that's not typically the case. Here we got the home value. You can borrow like half or less, which is kind of disappointing now, but in the future, you're going to be very glad for it, because not only do we have increased quick appreciation, but pretend we didn't. That loan balance has so much more room to travel, and because it's a lower amount, it doesn't grow as quickly, right? Interest on $1, let's say 5% interest on $1 is 5 cents. 5% interest on $100 is $5. That makes a big difference. And we're talking much larger numbers than that, right? We're talking hundreds of thousands when we talk about mortgages. And so the larger that loan amount is, the faster it grows. But we're starting way down here. And we're during a time when appreciation is going crazy. That's not predicted to change. We're not expecting any huge market crash. But even if it did, you're still protected. If, for whatever reason, the reverse mortgage value, the balance on the reverse mortgage were to be higher than the home's value, you don't have to do anything. You can still live in the home, continue paying your property taxes, homeowners insurance, HOA, maintaining the home, living in it as your primary residence. Nothing happens simply because of that situation. That's pretty unique. Most other mortgages, and we see that with, home equity line of credits, like the ones the banks are always trying to put at you, they're really inexpensive. They're interest-only payments for the first 10 years, and then they amortize in the next 20 years. You have these huge payments. Not a good thing for retirement. But what we see is those get frozen in times where the real estate market crashes. The reverse mortgage line of credit doesn't. It's FHA insured. So at a time when people need that money the most, we see HELOCs, home equity line of credits, being frozen. And you still have to make that payment, though. Don't forget. But the reverse mortgage, the line of credit is still available to you, and there's no payment on it. Now, that's a whole different video, but it's a really, really important concept to understand why a reverse mortgage is a great tool for retirement. People not in retirement have different income situations. They can make more over time. All right, that's the end of the slideshow. Thank you so much. I hope you understand what a reverse mortgage is. Check out some of my other videos, subscribe to our channel, and I hope you get educated, and I'd love to work with you if it makes sense.